Namaste, good evening, and hopefully we have one more good session of understanding taxes. Okay, right? We will start. Capital gains is the next area of our focus today. The first area of our focus before we take the first break, we should be able to complete this because it's a standalone chapter to a larger extent, and to an extent one understanding we will be able to do it. Okay, we start. Friends, to tax an income under capital gains, two conditions needs to be fulfilled. To tax an income under capital gains, two conditions needs to be fulfilled. One, it should be a capital asset. Two, it should have been transferred. Two conditions, it should be a capital asset and it should have been transferred. If these two conditions are satisfied only, we enter this chapter. That takes us to the understanding of what is a capital asset and what is transfer. Okay, these are some of the list of capital asset: land and building, shares, jewelry, intangibles, okay, like goodwill, etc., debentures, bonds, work of art, architecture, painting, and depreciable assets or capital asset. Okay, I want to be clear. A movable depreciable asset is a capital asset, whereas a movable personal asset is not a capital asset. Okay, movable car which is used for business is a capital asset. Car which is used personally by you is not a capital asset. Okay, there are exceptions. The law also says what is not a capital asset. RAL, rural agricultural land, is not a capital asset. Somebody waiting. Rural agriculture land is not a capital asset. Stock in trade is not a capital asset. Movable personal assets. Personal asset means used for domestic purposes other than jewelry, work of art, architecture, painting are not capital assets. So the law tells us what is capital asset. Okay, we now understand what is a capital asset, and more importantly, we understand what is not a capital asset. Similarly, there are two conditions. The second condition is it should be transferred. The word transfer is so huge. The word transfer is so huge. It includes sale. It includes barter system, exchange. Okay. We have seen in our regular class specified agreement. I give land and building. He constructs me and gives me. It's an exchange. Relinquishment, taking away a right. Okay, sale of rights, okay, is relinquishment. Okay, extinguishment, destroyal of an asset. Okay, conversion of asset into stock in trade, compulsory acquisition, introduction by partner, dissolution of a firm are some of the examples of transfer. And there are some exceptions. Gift and inheritance is not regarded as transfer. Amalgamation, demerger, holding subsidiary, HUF to members, all these things, okay, are not regarded as transfer, So there should be two conditions which needs to be fulfilled: capital asset and transfer. Okay, what is capital asset, what is not a capital asset, what is transfer, what is not considered as transfer. Then comes the key aspect of how will you classify the assets, what are all the methodology of classifying the asset. Assets are classified into short term or long term. The word term means period. The period of holding between the date of buying and date of selling is known as term. Between the date of you getting it, buying, or you selling it. Okay. In the case of listed shares, okay, this is enough for you. Okay, other two are just okay, 12 months. Okay, it is short term. In the case of immovable property and private limited company or unlisted shares, 24 months. In the case of any other asset, okay, in the case of jewelry, in the case of okay, some other assets, the period is 36 months. Okay, listed shares, unlisted shares, debentures, jewelry, bonds, everything comes to 36 months. Okay, point to remember: in the case of gift, inheritance, amalgamation, conversion, for classification, include the period of the previous owner too. I told you what is the word term means. Term means the date of buying and selling. In between, if there is a gift, inheritance, amalgamation, demerger, conversion, holding subsidiary transaction, all these things are not regarded as transfer. Okay, so the law says don't take this event at all. I will still consider the date in which it is purchased by probably the previous owner and the date, the current date of sales. The date, okay, so that will only be taken not by the present owner. This leads us to an important case law very soon. Okay, how to
So very sorry
compute.
to disturb you.
Listening?
Sorry to interrupt. Ritanya is not able to join. She's telling.
Oh, sorry. In the midst, I forgot that I have to just remind me if somebody is unable to join. I'll come in every 5 minutes and see if there are people waiting in the queue. So, previous owner, okay, the period of holding of the previous owner will also be computed, okay, and for the purpose of our understanding, in our notebook, let us once write the formula or format, okay, computation of capital gains. Okay, let us once write, please write it in the notebook so that we are very clear. The answer leads us to net consideration. Cost of acquisition, okay, cost of acquisition in the case of STCA and indexed cost of acquisition in the case of LTCA. Cost of acquisition in the case of STCA, indexed cost of acquisition in the case of LTCA, cost of improvement in the case of STCA, and indexed cost of improvement in the case of long-term capital asset. Okay, this leads us to, okay, so here I'm hitting at a point called gross STCG slash LTCG. Gross LTCG slash STCG. STCG or LTCG. Exemptions under section 54. Exemptions under section 54. Okay, 54, 54B, 54 EC, 54D and 54F are the various exemptions that will be provided, leading us to taxable STCG slash LTCG. Fifty-four B is only for is also for STCG. 54D is for business associates. 54, 54 EC, 54F are only for LTCA or LTCG. 54G is also, which means it is both for LTCA and LTCA. Okay, I'm writing the next note. If this is note 1, I'm writing the next note. If the result is a loss, then STCL can either be set off slash carry forward and set off against STCG or LTCG. Okay, in case of LTCL, it can be set off. Set off means same year. Carry forward and set off next year only against LTCG. In case of STCL, it can be set off against STCG or LTCG, even carry forward and set off. Whereas if it is LTCL, be it current year, be it subsequent years, it can be only against the LTCG. Okay. Normal LTCG is taxable at 20%. Normal LTCG is taxable at 20%. Normal STCG is taxable at slab rates. That doesn't have a special rate. It goes to general rate. Normal income. Income taxable at normal rates. There it will go. Okay. STCG on which STT is paid. Okay, STT stands for Security Transaction Tax, 15%. Okay, this is under Section 111A. LTCG on which STT is paid is 112A. It is taxable at 10%. Okay, for the amount exceeding rupees 1 lakh. For the amount exceeding up to 1 lakh, it is not taxable. Beyond 1 lakh, 10%. Okay, so this is the structure. So have these also as notes. Okay, so we are very clear about various things. A quick look at the entire format once. A quick look at the entire format once. Okay, normally, my dear friends, full value of consideration means, normally, my dear friends, okay, full value of consideration means sale consideration. Normally, sale consideration. But in some cases, we call it as deemed FVC. We call it as deemed full value of consideration. Okay, in some cases I will take deemed full value of consideration. What are all the case? If it is destroyal of an asset, if it is destroyal of an asset, insurance compensation, that is the compensation paid by the insurance company, will be taken as full value of consideration, and it is taxable only in the year in which it is received. Okay, only in the year in which it is received. Okay, so full value of consideration is normally sale consideration, some cases deemed consideration. Compulsory acquisition, I will take only whatever is the payable by the government. Okay, and the taxable in the year in which it is received. Okay, taxable in the year in which it is received. Okay, asset converted into, okay, asset converted into SIT, stock in trade. This morning we saw stock in trade converted into asset. FMV on the date of conversion. Full value of consideration is FMV on the date of consideration in the year in which stock is sold. In the year in which stock is sold. So, if somebody tells you that capital gains is taxable in the year of transfer, correct? The answer is yes, but there are some exceptions. I am repeating. If people tell you that capital gains is taxable in the year in which the asset is transferred, they are right. That is correct. But there are some exceptions. Insurance extinguishment of an asset is a transfer. Are we taxing it in that year? No, in the year in which compensation is received. Compulsory acquisition is a transfer. Are we taxing in that year? No, in the year in which it is received. Conversion of asset into stock in trade is a transfer. Are we taxing in that year? No, in the year in which stock in trade is sold. So technically we say in these cases the numerator will not be 289. Normally for all of us 1920 financial year, the numerator should be 289, but in these cases, the numerator will not be 289. It can be any of the preceding years. Okay, stock in trade converted into capital asset, FMV on the date of conversion. Okay, PGBP is taxable. Capital gain is in the year in which this stock in trade is sold. Okay, so no problem here. Okay, this is a new provision. So not for capital gains. Asset introduced by partner into the firm, value recorded in the books. Okay, the difference is here. If I introduce the asset as capital stock in trade, FMV. If I introduce asset as partner as capital contribution, value recorded in the books. Dissolution, FMV on the date of distribution to partners. Okay. Now, section 50C. Section 50C. Friends, this is sale of immovable property, land and building. Sale of immovable property. Stamp value or actual consideration, whichever is higher. Repeating, actual consideration or stamp value, whichever is higher. However, where the stamp value does not exceed 105% of actual consideration, then actual consideration will be taken. Tolerance limit. 1 lakh sale consideration 1 lakh 2,000 stamp value. It's okay. 5% there will be some deviation. So you will take only 1 lakh where the stamp value does not exceed 105% of actual consideration. Then you should take only actual consideration. Then you should. Now, for all those who are seeing the video, the connection went lost. So I'm repeating whatever I have been staying in the classroom. Okay. So did you, this is exemptions are 54, 54B, 54EC, 54D and 54F. Notice 54B is also for STCG. 54B is also for STCG, which means it is for LTCG as well as STCG. It is for LTCG as well as STCG. Okay, right. 54D is only for business purposes. We will see it. Don't worry. 54, 54EC, 54F are only for LTCG. Are only for LTCG. So this is also for LTCG as well as STCG. 54D is for business associates, and these things, these three are only for LTCG. Did you take up this note, friends? Did you take up these notes before the connection was lost? Or now only you are taking up?
Only we are taking.
எனக்கு போனதே தெரியாது. நான் பட்டு நடத்தின்னு இருந்திருக்கேன். இப்பதான் அவெல்லாம் வந்துட்டு நாங்கெல்லாம் ரூம்லயே இல்ல அப்படின்ற. ஓகே, பட் என்ன ப்ராப்ளம்? So did you take it? Sorry, somebody was answering me. சாய்லக்ஷ்மி இதெல்லாம் எடுத்துட்டீங்களா? ராம்குமார் or தர்ஷித்?
சார் இதுவரைக்கும் எடுத்துட்டோம்.
முடிச்சிட்டோம் சார்.
Okay. Did you take up this second note which I gave or not yet?
No, sir.
No, sir.
Not yet, sir.
Okay, right. So I start from here. Friends. So note 2, write it as note 2. Okay. Okay. If this is note 1, this is note 2. Okay. If the result is a loss and it is STCL, the same can be either set off or carry forward and set off against STCG or LTCG. Repeating, if the result is STCL, okay, if it is gain, fine, we go up to taxable. If it is STCL, STCL can be set off either against STCG or LTCG, and same for carry forward also. Okay, same for carry forward also. Yeah. Sorry for all of you. You had texted me. I don't want to get disturbed, so I put it in, but I never realized. In case of LTCL, in case of long-term capital loss, it can be set off or carry forward and set off only against LTCG. Only against LTCG. Now comes note 3. Now comes note 3, my dear friends. I gave the rates. Okay. Normal LTCG 20%. Normal LTCG 20%. Normal STCG is taxable at slab rates. Okay. Okay. STCG is taxable at rates. Okay, normal income taxable at normal rate, so it's taxable at slab rate. STCG on which STT is paid is taxable at 15%. LTCG on which STT is paid, first 1 lakh exempt, balance is taxable at 10%. Amount exceeding 1 lakh is taxable at 10%.
Sir,
Listening friend.
sir, if it is STT is paid means it will be the case of shares only, no, sir.
Listed shares தான்.
Okay, sir.
Okay, and then I was telling that we go back to the format. We go back to the format, a quick understanding of the format. A quick understanding of the format. Normally, full value of consideration means sale consideration. Normally, full value of consideration means sale consideration. But okay, normally full value of consideration means sale consideration. But in some cases, I will take what is popularly known as deemed consideration. In some cases, I will take what is popularly known as deemed consideration. Actually, I was explaining the whole thing. Okay, then only I realized I just went to take my specs. That is the time I realized that I missed the contact. Okay. Anyhow, what are all the case of deemed consideration? What are all the case of deemed extinguishment, destroyal of an asset? I will take the insurance compensation and I will tax it in the year of receipt. I will tax it in the year of receipt. Compulsory acquisition by the government, whatever compensation paid by the government, again taxable in the year of receipt. In the year of receipt. Asset converted into stock in trade, FMV on the date of conversion. FMV on the date of conversion, but it is taxable only in the year in which stock in trade is sold. It is taxable only in the year in which stock in trade is sold. My dear friends, okay, normally if somebody asks you a question, is capital gain taxable in the year of transfer? The answer is yes. These are exceptions. Normally, capital gains is taxable in the year in which asset is transferred. But here are some exceptions to that rule. What are all they? Insurance compensation. Though I have lost the asset some year there, but in the year in which I receive it. Though government has taken over my asset in some year, in the year in which I received it. Though asset is converted into stock in trade, but the year in which stock in trade is sold. In other words, for our ease of understanding, we always say, normally our numerator is 289. Normally our numerator is 289, but in some cases it will not be 289. Normally our numerator is 289, but in some cases it will not be 289, it will be some other preceding years. So that is why we call it. Stock in trade converted into asset. This morning I was telling this was PGBP. The sale value will be taken. Asset introduced by the partner. Value recorded in books. Value recorded in books. Why I am saying is because here asset converted into stock in trade, FMV on the date of conversion, whereas here value recorded in books. Dissolution of a firm, FMV on the date of distribution. Okay. Sale of land and building. Friends, stamp value or actual consideration, whichever is higher. However, if the stamp value does not exceed 105%, actual consideration is 1 lakh. I sell it for, actual consideration is 1 lakh. Stamp value is 1 lakh 2,000. That 2,000 can be a real variation. So we call it 5% tolerance limit. 5% tolerance limit. That's why. Okay. Specified agreement. What is the specified agreement? It is exchange. Okay. I give land and building. The builder builds and gives me some apartments. Stamp value on the date of completion certificate plus cash consideration. Taxable in the year of completion of construction. Okay, but I understand this is not there in our intern. We have done solutions, so you know. If property is sold before considers completion, then year of sale. Okay, okay. So these are all some of the cases where sale consideration will not matter, full value of consideration, less cost of transfer, brokerage, stamp duty, okay, any expenses incurred for transfer, I will get net consideration. This point is essential for me, especially for a section called 54F, because it is formula based divided by net consideration. So in all question, we will hit at the point of net consideration less COA or ICOA. First C, what is cost of acquisition? The purchase price of the property. What is cost of acquisition? The purchase price of the property. Are there any exception to this rule? The answer is yes. Okay, okay. In some cases, deemed COA will be taken. In some cases, deemed COA will be taken. What are all the cases? Normally, this is the purchase price. Any expenses incurred at the time of purchase will be. However, in some cases, deemed cost of acquisition will be considered. Okay, deemed COA. What are it? Asset purchased before 1/4/2001. The reason being, the asset purchased before 1/4/2001. The reason is very simple. That is, the indexation starts from 2001 to actual cost. Please try. Okay, the formula has changed. That's why I'm striking this off. Okay, please. Okay, this was the old formula. Now there is a new formula. Actual cost or FMV as on 1st April 2001, whichever is higher. Asset acquired through gift or inheritance, cost of the previous owner, cost of the previous owner, and if the previous owner has purchased it before 1/4/2001, same. Conversion of debentures into share, cost of shares is cost of debentures. Depreciable asset, opening WDV plus additions made. This morning we saw when it will arise. Slum sales is net worth. Slum sales is net worth. Bonus shares issued after, this is before, this is after. I interchanged. Okay. Bonus shares issued before 1/4/2001. Bonus shares issued before 1/4/2001. Okay. It is FMB as on 1st April 2001. After 1/4/2001, nil. Please somewhere write and keep. It is before 1/4/2001. FMB as on 1/4/2001. After is nil. Renunciation of rights, license fees, etc. nil. Section 112A. Okay. LTCG on sale of shares on which STT is paid. There is two-way computation. We will see it little later. We will see it little later. Okay. Right. So this is where we are. This is where we are, and cost of improvement is any expenditure, capital expenditure after acquisition. Okay. Some notes which you are going to quickly take. Some notes which you are going to quickly take. Okay. The first note you are going to write it is ICOA formula, indexed cost of acquisition formula. Okay, I want the class to understand the whole way in which you have written it in the classroom. Okay, when will the numerator change? When will the denominator change? Okay, like that we are going to write it. So leaving 2-3 lines, you are going to start writing it. Okay, heading is ICOA, indexed cost of acquisition formula. Indexed cost of acquisition formula. That is the heading. Leaving 3-4 lines. Leaving 3-4 lines. COA, cost of acquisition, into 289 divided by CII of the year of acquisition. Repeating, ICOA is equal to COA into 289, that is 1920's indexation value, divided by CII of the year of acquisition. Now this 289 will change in 4 circumstances. Upward looking diagram, 4 circumstances it will change. 4 different circumstances it will change. 4 different circumstances it will change. Upward, the flower bracket which goes up really as a flower. Okay. The extreme left. The extreme left. Okay. Year of extinguishment. Year of extinguishment. In the case of insurance compensation, it is year of extinguishment. The next one, year of compulsory acquisition. Year of compulsory acquisition. The third one, year of conversion into stock in trade. Year of conversion into stock in trade. Year of conversion into stock in trade. Fourth one, year of entering into specified agreement. Year of entering into specified agreement. So it will not be 289 in these 4 cases. Okay, it might be some other year. If suppose it is in the same year, fine. Otherwise, it will be some other year. The denominator you would have written CII of the year of acquisition. In the denominator you would have written CII of the year of acquisition. 3, okay, 3 lines or the flower bracket with 3 branches, the tree diagram. Extreme left, asset purchased before 1/4/2001, 100. Asset purchased before 1/4/2001, 100. Middle branch. Middle branch. Asset acquired by gift or inheritance, hyphen, year of gift or inheritance. Year of gift or inheritance. Extreme right. Extreme right. Debentures converted into shares. Debentures converted into shares. Year of conversion. Year of conversion. 4 cases it might not be 289. 3 cases it might not be CAA of the year of acquisition. Okay, right? Right? So whoever has drawn it correctly, you know we have done it in the regular classroom. Can you take a pic and put it in the group itself so that others can also have it? Okay, I remember our friends were doing that last time also. Kindly put it in the group. Okay, right. Now this is my understand. This is the what I want the class to understand. All of us in the classroom. Okay. Okay. There is this very big case law called Manjula J. Shah. Manjula J. Shah case, which is a judgment by Bombay High Court, which is a judgment by Bombay High Court, Manjula J. Shah case. Manjula J. Shah case, it is a judgment by Bombay High Court, it is a judgment by Bombay High Court. What is that case law? The case law judgment says, if there is gift or transfer, period of holding, previous owner holding period is also taken. You say, we saw in the beginning itself, we saw here, point to remember, in the case of gift item for classification, include the period of previous owner. In case of COA, previous owner COA is taken. What will be the cost? Cost of the previous owner. So, the court, Bombay High Court said, when you consider the previous owner's holding period, I am repeating, class understand. If you are considering the previous owner's holding period, you are considering the previous owner's cost of acquisition, then consider previous owner's cost of CII also. So what we are doing, divided by year of gift or inheritance. The judgment says, no, you should give the previous owner. Whenever the previous owner has purchased it, that only should become the denominator. In other words, the formula should not change. The formula should be year of acquisition only. The formula should not change. Is the contention of Manjula, is the judgment of Manjula Desha's case. But it is a judgment only by High Court. If it is a judgment of the Supreme Court, we would have taken it. It is a judgment of the High Court. And you also have to remember that law is clear. What is the denominator? Year in which asset is first held by assessee. The year in which asset is first held by the assessee. That is what should be the denominator. This is what law tells us. Law tells us year in which asset is first held by the assessee. Sir, I am giving a gift to, Darshit Kotari. I am giving a gift to Darshit Kotari. Divided by year in which asset is first held by the assessee. Ipo, Darshit Kotari sells it. So I am not the assessee. For me, it is not taxable. Gift or inheritances. But Darshit Kotari is the assessee. Divided by, the law. Technically, the law formula is, year in which first held by the assessee. When will Darshit Kotari first held means ownership. When will Darshit Kotari first hold the assessee? When I gave him as gift, in the year of gift. So, law says it is divided by the year of gift. Whereas Manjula J. Shah judgment says it is divided by in the year in which you got it. There is not yet clarity. So in all these type of questions, we will work out only as per law. Our institute is very clear. We work as per law, but we will write a small note. You need not even remember Arun Shuglu Trust, Manjula J. Shah case held that when we take holding period of the previous owner, when we consider cost of the previous owner, indexation should also be considered. This is a small note we will give because our answer will stand. We will work out the answer only as per law, but this is a small note which we will give. Okay. Okay. Right. Okay. Yeah. Thank you, friend Vitanya. Okay. Now shall we proceed again? Yes, friends. Okay. Now, note number, the second thing which is very interesting to understand. Now we saw a change. Okay, which I am speaking about is this actual consideration or stamp value. I am going to consolidate three provisions in your notebook. I want you to consolidate three provisions in your notebook, please. Three provisions in your notebook, please. Okay. Okay. Have three columns, equal columns. Have three equal columns, my dear friends. Okay. Okay. Have three columns. First column, equal column. Section 43CA. Section 43CA. If immovable property is held as stock in trade. Okay, section 43CA, if immovable property is held as stock in trade. Middle column, section 50C, if immovable property is held as capital asset. If immovable property is held as capital asset. Extreme right column, section 56. Inadequate consideration of immovable property. Okay, three columns. 43CA, if immovable property is held as stock in trade. Middle, 50C, if immovable property is held as capital asset. Extreme right, section 56, inadequate consideration of immovable property. The first two is for the seller, the third one is for the buyer. The first two is for the seller. Okay, if you technically look at it, these two things is for the seller, whereas this is for the buyer. Okay, right. Now let us come back to the columns. Okay, in the first column, okay, sale consideration will be actual consideration or stamp value, whichever is higher. Actual consideration or stamp value, whichever is higher. However, where the stamp value does not exceed 105% of actual consideration, then actual consideration will be taken. Okay, what is sale consideration? Okay, in that column, sale consideration will be actual consideration or stamp value, whichever is higher, where the stamp value is not exceeding 105% of actual consideration, then I will only take actual consideration. Tolerance limit. Tolerance limit. Okay, middle column, if it is held as a capital asset, then the same provision. FVC, full value of consideration, will be actual consideration or stamp value, whichever is higher, and the same note. Okay, and the same note, my dear friends, the same note. However, where the stamp value does not exceed 105% of actual consideration will be taken. Same. So you see the relationship between sections, okay, it will be the same. Section 56, inadequate, okay, it is for the buyer. It is for the buyer, okay. Okay, so I'll write it little elaborate so that you are clear. Difference between stamp value and consideration paid is known as inadequate consideration. Difference between stamp value and consideration paid is known as inadequate consideration. Difference between stamp value and consideration paid is known as inadequate consideration. Where inadequate consideration exceeds rupees 50,000, the whole of, okay, inadequate consideration becomes taxable. Okay, where inadequate consideration exceeds rupees 50,000, whole of such inadequate consideration becomes taxable. Now for the exception, however, where the difference does not exceed 105% of consideration, then it is not taxable. So in all the three places, you see the relationship. 43C is stock in trade, buyer. 50C, capital asset transfer, immovable property, buyer. Gift provision under 56, inadequate consideration. In all the three cases, 5% is the tolerance limit. In all these three cases, 5% is the tolerance limit. Okay, okay. Now
So
for,
just a minute, sir.
yeah, take your time. Now for the third note. Now for, okay, note number 1, Manjula Jesha case. Note number 2, the three sections and their behavior, which are interrelated. Now for the third, okay, which I told you, we will write it separately. Section 112A, COA for listed shares. COA for listed shares. If listed shares are acquired after 31/1/2018, then take whatever is the actual cost. No problem. If it is purchased after, that is from 1st February 2018, if it is purchased, then take the actual cost, no change. If listed shares are acquired, okay, right, before, no, actually, on or before 31/1/2018. If listed shares are acquired on or before 31/1/2018. Step 1. Actual full value of consideration or FMV as on 31/1/2018, whichever is less. Step 2. Answer of step 1 or actual cost of acquisition, whichever is higher. Okay, whichever is higher. So please understand, okay, how to compute the cost of acquisition of listed shares. If it is purchased on or before 31/1/2018, it is like this. It is like this. We have seen this in the classroom as well. Okay, up to rupees 1 lakh, it is not taxable. That is, it is exempt. Okay, capital gain exceeding rupees 1 lakh is taxable at 10%. Is taxable at 10%. Benefit of indexation not available. Okay, here it is. Long term, because short term comes under 111A, which is long term. Okay. Before
So
going
just a
into,
minute, sir.
yeah, sure. Before going into the other things, now I'm going into amendments. I'm going into amendments. Okay, PGBP we saw capital gains 50C, 43CA, everything has a 5% tolerance limit. Has a 5% tolerance limit. We now gave you the three things. Transfer of shares of unlisted company, only an administrative provision. Do not worry. Okay, now this is the major change and the questionable area. 54. Exemption extended to two house property. In the case of individual and HUF, LTCG for transfer of house property does not exceed 2 crore. So, if it is up to 2 crores, does not exceed, so up to 2 crores also, then he shall be eligible to claim exemption for two new house properties. And this can be claimed only once in lifetime. Again, you cannot claim for two, you can claim for one. Okay, so if it exceeds 2 crores, it is only one house property. This is one major amendment. Okay, since May exam did not happen, only in all amendments can be tested only in November. Okay, here now you need not go deeper into it. You already have an idea. Section 54 only for individuals and HUF, only for long-term capital gain. Asset transfer should also be house property. Asset purchase should also be house property. Time limits for purchase 1 year before or 2 years after the date of transfer. For completion 3 years from the date of transfer. Amount invested including deposit or gross LTCG, whichever is less. Do not transfer the new property within 3 years, etc. So I have not brought the amendment here because I know amendment I have kept it separately. But here the amendment is if the gross income, if the gross LTCG does not exceed 2 crores, you can claim for 2 properties. Otherwise, only 1 property. 54B, okay, sale is an agriculture land, obviously urban agriculture land because rural agriculture land is not a capital asset. Purchase is another agriculture land, 2 years from the date of transfer, actual or gross gains. Why I am writing this is because this is also available for short term, both short term and long term. Both short term and long term. Okay. Okay. Both short term and long term will enjoy this benefit. EC, the thing to remember is it is only 6 months from the date of transfer you should buy NHA, and again it is only for LTCG and maximum is restricted to 50 lakhs. F. Sell any asset, jewelry, vacant land, agriculture land, sell any asset. What you should buy is house property. Formula based. There is only one except, that is, assessee should not be the owner of more than one house property. You can assume these conditions if the question is silent. Patiently read it for 2 minutes. Patiently go through along with the amendment. I have not put the amendment here because I'm taking the amendments separately. That's why.
Sir, sorry, up to 2 crores LTCG and once in a lifetime is the new amendment, sir.
New amendment amount only for your year it is incorporated.
Okay, sir.
Okay, Akshaya, இவ்வளவு பெரிய extra, I understand. சும்மா இருந்தாலும் நாளைக்கும் கிண்டல் பண்ணுவேன். Shall we go for the practical understanding, friends? Okay, I'm in question number 1 of our revision material, page number 38. Ritanya has sold land and building for a total consideration of 72 lakh. Stamp value on that date 75 lakhs. Compute taxable capital, capital gain and tax payable. Ignoring her other income, compute the tax only for capital gains. If the property is purchased in 2004-5, if the property is inherited from her great grandfather in 2001, her great grandfather has purchased it for 74,000, FMB 7 lakh. If the property is gifted by her father in 11-12, her father has purchased it in 2002-3, FMB on the date of gift should always be ignored. Should always be ignored. If the property is acquired by Ritanya herself in 1819 for rupees 60 lakhs. Okay. The one help I look forward from you is one of you please have the ICOA working near you, so that please help me. Okay. Full value of consideration in case A or in any case. Oh, okay. Full value of consideration, please wait. Okay. Actual consideration 72 lakhs. Okay. Actual consideration 72 lakhs. Stamp value 75 lakhs. Correct? Stamp value 75 lakhs. 105 percentage of actual consideration. 105 percentage of actual consideration, since stamp value has not exceeded 105% of actual consideration will be taken as full value of consideration. I hope. Okay. Stamp value, if it is 76 lakhs, I would have taken only 76 lakhs. But since it has not exceeded 105, that is the amended, and that is the beauty of this provision. So I will take only 72 lakhs. I will take only 72 lakhs. Less ICOA. Okay, what is that? Okay, if the property is purchased in 2004-5 for 18 lakhs, 18 lakhs into 289 divided by 2004-5. Somebody have it?
130.
113, yeah? Okay, so my dear friends, 1 lakh 18 lakhs, okay, into 289 divided by 113. So I get gross slash taxable LTCG, gross slash taxable LTCG as, okay, 25 lakh 96,460. 25 lakh 96,460. Okay. Okay. So base tax at the rate of 20%, since it's a LTCG. We have said only compute tax, ignoring our other income, compute the tax only for capital gains into, okay, 20% and HEC at the rate of 4%. Only if I include the other incomes, I will know whether surcharge will come, what is the benefit, or whether as a basic exemption. That is not the intention is how to tax LTCG. Part B, I start with net consideration. We already know we have computed 72 lakhs. Okay, less ICOA. Okay, this property is gifted by a grandfather in 2001. Then no problem. I will take the FMV as on 2001. 7 lakhs into 289 by 100. Okay, so here. Okay, here, okay, here I will stop with base tax because surcharge is coming. Okay, because already this is okay, we'll do surcharge also, and surcharge at the rate of 10% since LTCG by itself exceeds rupees 50 lakhs. Okay, so surcharge is 10% and HEC at the rate of 4% on tax plus surcharge. On tax plus surcharge.
Sir,
I'm listening.
sir, here relief come.
Once more. Marginal relief.
Yes, sir.
அது 1 lakhs. Okay, ஒரு amount நமக்கு வந்து we don't know the other incomes. So இது LTCG க்கு மாத்திரம் நம்ம போடுற tax. Marginal relief நாளைக்கு பார்க்கலாம். I will tell you again.
Sir,
Raja,
sir, is the marginal
அதான்டா ராஜா, மார்ஜினல் ரிலீஃப் இந்த கொஸ்டின்ல வராது பிகாஸ் 177 இங்க 103 அதனால வராது ஒன் டைம். அண்ட் இது வந்து எல்டிசிஜிக்கு மாத்திரம். we are only doing for LTCG, don't worry about marginal relief.
okay, sir.
Okay, now my dear friends, case 3. Okay, part C. Okay, net consideration. Okay, part C. Part C. I am going to do it. Please listen. Class, please listen. Part C. As per law, as per Manjula J. Shah judgment. Okay, I will work out and show you. Please listen, class. Okay, normally we were used to work out only as per law. Net consideration 72 lakhs. Net consideration 72 lakhs. Okay, less ICOA. First, as per law work பண்றேன். She got the gift in the financial year 11-12. Okay, so 6,40,000 into 289 divided by 11-12. Can somebody tell me?
184.
184. That is nothing but 2011-12. Okay, okay. So it will be say okay 6,40,000 into 289 divided by 184. 184. Okay. This is as per law. Manjula Desha case says, no, you can take the benefit of the previous owner itself. Okay, you can take the benefit of previous owner 2002 3 100 105 105
Yes,
Yes,
sir.
sir.
Yes, sir.
105. Okay, nothing but 2002 3. This is year of acquisition by previous owner. Okay, but this is year of gift. This is year of gift. My dear friends, okay, so 6,40,000 into 289 divided by 105. Okay, so gross LTCG. So this is the difference. Let's not work out tax. Let's not waste time. You know how to work out tax. So this is the difference between Manjula Jesha judgment and law. You can see the difference is to the tune of 7 lakhs. In this case, depending upon the case to case, it will change. So we are not required to do this answer. If you find time, do this answer. But otherwise, write a note. As per Manjula Jesha case, okay, denominator can be 105. Why? When you take the cost of the previous owner, I am taking 640. When you take the holding period of the previous owner, take the indexation of the previous owner. That is the judgment.
Sir,
Raja?
if the acquisition made by the previous owner is before 2001, it will be 100, right, sir?
Oh, very good, Raja. Okay. Part D, it's a short-term capital asset because she has acquired only it in 1819 and selling it in 1920. Okay. Net consideration, okay, 72 lakhs less cost of acquisition, less cost of acquisition 60 lakhs. Okay, gross STCG, gross STCG. Okay, this will be 12 lakhs taxable at slab rate. Okay, this will be taxable at slab rates. Question number 2. Rohit land is compulsorily acquired by the government 11th November 2018 in the compulsory acquisition, extinguishment and all you study, underline the date immediately. We all know numerator will be 1819. A compensation of 64 lakh 15,000 was paid on 11th November 2019. Rohit has purchased this land for 1740 in July 2016. Rohit invested in REC bonds 30 lakhs in January 2020. Okay, up to this we will do and then study the next session. Okay, up to this we call it as a card. Okay, then we will go for additional working. Question number 2. Okay. Is compensation and compensation of 64 lakh 15,000. 64 lakh 15,000. Okay, computation, I'll write it here. FY 1920 as compensation is received in November 19. Okay, less cost of transfer, nothing is there. Net consideration is also 64 lakh 15,000. Is also 64 lakh 15,000 less ICOA. Okay, what is the purchase price by him? He has purchased it for 17 lakh 40,000 in 6/7. So 17 lakh 40,000. Yeah, okay, 17 lakh 40,000 into 280. That is financial year 18-19 divided by 6/7.
122,
120.
sir.
Thank you, Dashwa.
122.
Yeah. Oh, okay. 2006-7. So the important thing to understand is this is 280 because the numerator is the year in which I destroyed. I mean the government acquired the property. Okay. 17 lakh 40,000 into 280 divided by 122. Okay. Gross LTCG. Gross LTCG, okay, is this much. Okay, exemption under section 54 EC. Okay, gross LTCG or amount invested maximum limit, so that I'm writing it detailed because you can easily understand these things. You will in the examination directly put the amount. Okay, minimum of these three things. Okay, taxable LTCG, okay, is nil. Taxable LTCG is nil. Sorry.
Sir,
Hmm.
sir, if the compensation is received anytime after March 2020, then we'll not do the calculation at all, no, sir, for 1920.
ஆமாம் அந்த மாதிரி கொடுக்க மாட்டாங்க. Additional compensation subsequent yearல கொடுத்தாலும் in that year it is taxable. I am going to write that. Okay. If it is, if compensation, if I have no capital, because that year we cannot do that.
Okay, sir.
Okay. Rohit also went on an appeal against the compensation provided. Court enhanced by rupees 15 lakhs by passing an order in November 20. Rohit spent 3 lakhs as legal fees. However, the enhanced compensation is received only in 2022 along with interest of 1,14,000. So, I'm trying to tell you two things. Okay, as our friend is saying, note, enhanced compensation is taxable in the year of receipt. Okay, legal expenses can be claimed as deduction. So in the year 2022 this will be Okay. Interest on delayed payment of enhanced compensation is an income for the receiver only in the year of receipt, and 50% of such interest is allowed as deduction. This is house IFOS allowed as deduction. Okay, so we now know this also how to look at it.
Sir, uh,
Listening.
sir, and the exemption, it should be deposited within 6 months, no, sir, 6 months from the date of receiving the compensation.
Compensation, because otherwise receipt of transfer, but here receiving the compensation. Your understanding is right. Question number 3. Vidya and Sai Lakshmi started their own firm, Yopavam, and introduced the following assets as capital contribution. Compute the relevant capital gains in their hands. Vidya transfer, actually it should have been Viji, and Vidya okay. Vidya transferred unlisted shares of 6,15,000. Vidya transferred unlisted shares of 6,50,000. FMV 7,50,000. Whenever a partner introduces, we should only take what is value recorded in books, not what is FMV. These shares were purchased by her in 1415 for 3,05,000. And debentures of rupees 6 lakhs, which is purchased in 1516 for 5 lakhs. Now, miss panna vishayam, indexation benefit is not available for debentures and bonds also. So that's why I want to take up this question and work out and show you. Though it is a long-term asset, indexation I will not provide for debentures and bonds. Sai Lakshmi transferred a car for rupees 3 lakhs, not a capital asset, no capital gain. Not a capital asset, no capital gain, and listed shares for rupees 11 lakhs, which is purchased on 1st April 2018. Okay, right, for rupees 8,50,000. Okay, at least in the Excel sheet, let me be fair enough. Computation, capital gains of, I meant Viji only, okay, but I don't know. Every time I call her Vidya, even this today, okay, right? Particulars, okay, unlisted shares, debentures. Full value of consideration, okay, book value recorded in the books because it is partner transferring, okay, 615 and 6 lakhs, 6 lakh 15,000 and 6 lakhs less ICOA for unlisted shares, okay, less ICOA for unlisted shares, 3 lakh 5,000 into 289 divided by 1415.
240. 240.
240, yeah,
240.
yeah. யாருக்கு சொல்ல போறேன், யாரும் உனக்கு தெரிஞ்சு வந்து ராம்ஜி இருக்கான், அவன் சொன்னா அந்த டிஸ்டர்பிங் கேர்ள உள்ள விடாதீங்கன்னு சொன்னான். Less for debentures, no index benefit, even though it's a long-term capital asset. Okay, so 3 lakhs. I need to often check. Full value of consideration, listed shares 11 lakhs less ICOA less indexed cost of acquisition. Okay, 8 lakh 50,000 into 289 divided by 280. Purchased in 1819, sold in 1920, but more than 1 year. So indexation benefit is available. Okay, 8 lakh 50,000 into 289 divided by 280. Okay, so 877 gross LTCG, gross LTCG. Okay, 2 lakh 22,679 gross LTCG, 2 lakh 22,679. I thought some of you will object me doing the indexation for a listed share. I thought some of you, but two things. One, if you have understood, I'm really happy why I did indexation. Okay, if you are not looking at it, now I will explain you why I did indexation. Okay, one, this is not sold through stock exchange, so STT would not be paid. Only if STT is paid, we will go for that computation of 1 lakh, etc. and all. This is not in the stock exchange. Sai Lakshmi introduced it into a firm. So STT will not be paid. It is not through a stock exchange. Second thing, this LTCG is not taxable under 112A but under 112. The tax rate is 20%, not that up to 1 lakh it is nil, and more than 1 lakh it is 10%. Because it is not sold through stock exchange. Only STT pay. STT pay only if it is sold through recognized stock exchange. Otherwise, this is the computation.
So then even for debentures, bonds also, if it is introduced by a partner, then we have no indexation, sir.
Not only introduced by partner. For debentures and bonds, no indexation, even if it is a LTC.
But for shares alone, we have indexation if it is introduced.
Because it is not through a recognized stock exchange.
Okay.
Unlisted shares ki eppayume undu. Always we do for unlisted share. For listed share, normally we don't do because everything is transacted through stock exchange. But here is a case where it is not transacted through stock exchange.
Sir, what is the reason for the debentures not allowed?
Sir,
Indexation benefit.
indexation is for inflation, correct, Ram?
Yes, sir.
Okay. Ana interest vandrudu in the debentures kum bonds kum. So that will take care of inflation. So that's why they are not doing it.
Yes, okay, sir.
This one okay, solidra.
Sir,
I'm not for it. The government is wrong. Okay. Raja, sollu Abhi.
sir, listed shares the holding period more than 12 months இருக்கு. So can we assume in that way it's LTCG அப்படி அந்த ரூட் எடுக்கலாமா?
LTCG அந்த rule தான். See, applying of what is LTCG is different from computation. It is purchased on 1st April 2018 and introduced as capital in 1920. More than 1 year, so I have put the indexation. Normally, I should not put the indexation if it is sold through stock exchange. Since it is not sold through stock exchange, I have put the indexation.
ஓகே சார். ஸோ ஹோல்டிங் பீரியட் 1 இயர் மேல இருந்துமே ஸ்டாக் எக்ஸ்சேஞ்ச் மூலியமா பண்ணா இண்டெக்ஸேஷன் எடுக்கக்கூடாது.
கிடையாது. ஏன்னா நம்ம இப்ப எழுதியிருக்கோம் பாரு, நோட்லயே எழுதியிருக்கேன், பெனிஃபிட் ஆஃப் இண்டெக்ஸேஷன் நாட் அவைலபிள், எஸ்டிடி பெய்ட்.
ஓகே சார். ஓகே.
Specify the computation of capital gain and mode of taxation in the case of shares both listed and unlisted. Okay. Question 4. Okay. For unlisted shares, first I will put unlisted shares. Okay. Ennalam we should remember holding period 24 months or more, it will become a LTCA. Okay. Unlisted shares. Okay. Sale value, FVC, full value of consideration, actual sale price, or FMB, whichever is higher. Pona case la edukadukana partner, okay, is higher. Okay. Indexation benefit available. Okay. 112 will be applicable. Okay, that is 20% on the mari. For listed shares sold through stock exchange, because you will pay STT. Okay, holding period 12 months. Okay, FVC. Okay, actual sale price. COA. Remember the 2 steps we have written, so I am not again writing. Remember the 2 steps. 112A, that is up to rupees 1 lakh, nil, more than that 10%. For listed shares not sold through stock exchange, so no STT. Okay, holding period 12 months. FVC actuals. Okay, COA. Okay, actuals. 112 is only applicable. Okay, 20% rate. Index can be claimed. Here, sorry, I'll write one more point here itself. Okay, 111A for STCG 15%. Just make a marking somewhere. Question number 5. Sahu entered into an agreement with Mr. Devnesh to sell his residential property located at New Delhi for rupees 82 lakhs. Mr. Devnesh was handed over the possession of the property on 16/12 and the registration process was completed on 24/2. I wrote this, okay. I should have made a note here, okay. I will write it here. I request you to follow it, okay. For all these 3 sections, one more important point, all the common point, okay. While writing, while dictating, I was remembering, but I forgot to finally finish it. Here I am writing. If you have space, write it. Otherwise, put an asterisk mark somewhere on the margin space. Somewhere, if you can write it, it will be great because it's an important point. Okay. On which date stamp value should be taken? For all the 3 I am putting together, I am writing this. On which date stamp value should be taken? Okay. Where advance is received by, okay, I will fully write, later give you time, by account payee check, draft, banking channel, then, okay, date of agreement, then date of agreement, where no advance or advance received by cash or barrel check or cross the check, okay, date of registration. Okay, this is also something which I want the class to understand, where, okay, on which date stamp value should be taken. Always I say 105%, so actual consideration or stamp value, whichever is higher, on which date should I take the stamp value? Depends upon whether you pay advance or not through an approved channel. If you pay, date of agreement. If you don't pay advance, or you pay advance not through approved channel, date of registration. Somewhere can you make a marking, please?
Sir,
Ramji, listening?
sir, sorry, sir. I have disconnected during the fourth sum, sir. Can you please, once it is completed, can you please show this once again, sir?
Yeah. But anyhow, I will show it to you, and I'm also posting then and there. I have sent you the links. I'm posting then and there in the drive also. I will keep updating.
Okay, sir.
So remember this date of agreement or date of registration depends upon advance paid by proper channel or no advance or advance not paid by proper channel. Okay, remember this. With that we will approach the question 4 க்கு theory answer தான் எழுதியிருக்கேன். நீ கவலைப்படாதே, உனக்கு நான் டிரைவ்ல போட்டுறேன். Okay. Mr. Sahu entered into an agreement with Devnesh to sell his property located at New Delhi on 27/7/2019. That is the date of agreement. On which date 82 lakhs. Mr. Devnesh handed over the property and registration was completed on this date. Mr. Devnesh had paid the sale process at 25% through account payee check on the date of agreement. So, advance is paid by a proper channel. I will only take stamp value on the date of agreement. Advance is paid through proper channel. Okay, 50% balance on registration. The value determined by stamp authority on 27/7 is 92 lakhs, whereas 24/2 is 9450. Mr. Sahu has acquired this property in 2/3 for 21 lakh. After recovering the sale proceeds from Devnesh, he purchased another house property in Navi Mumbai for 35 lakhs. Compute the capital gains. Question number 6. The following listed shares are sold by Shyam Ganesh for the financial year 1920. He does not have any other income. Compute the taxable capital gain, compute the capital gain and tax due thereon. 300 shares of X Limited acquired on 1st January 2016 before 31/1/2018. These shares were acquired 2,100 per share. FMB as on 2018 31st Jan 2850 sold for 3,300. 200 shares purchased on 1st April 2018. Okay. So there is no before after 31. So directly I will take acquired for 2,800. I will ignore this. These were sold for 3,500. Assume STT is paid as per the provisions. Okay. So 300 shares into sale price is 3,300. 300 shares into 3,300 less cost of acquisition because benefit of indexation is not there. Step 1. Okay, full value of consideration which is 3,300 per share or FMV as on 31/1 2018, 31/1/2018, which is 2,850 per share, whichever is less. So I will take 2,850. Okay. Step 2. Okay. Okay. Answer of step 1. Okay, which is 2,850. We all understand. Or actual COA, actual cost of acquisition, which is 2,100, whichever is high. So 2,850 again. Okay, no indexation. Okay, for 300 shares, the COA will be okay 300 into 2,850. Okay, gross LTCG from X Limited. Gross LTCG from X Limited. I hope the class is following. It is 1,35,000. Gross LTCG from X Limited is 1,35,000. Now, Y Limited. Y Limited. Full value of consideration. Full value of consideration 200 shares 3,500. 200 into 3,500 per share. Okay, less COA. Okay, directly to be taken as it's purchased after 31/1/2018. So what we will do, we will take that the 2,800 is the purchase price, 2,800. So gross LTCG from Y Limited, gross LTCG from Y Limited, okay, 1,40,000. Total gross LTCG, total gross LTCG 2,75,000 less exemption 1 lakh. Taxable LTCG, okay, 1,75,000. Understand this? Since he does not have any other income and the taxable LTCG is not exceeding basic exemption limit, the whole amount becomes not tax, or sorry, the tax is nil. Question number 7. Krishna inherited his grandfather's land in May 2012. His grandfather has purchased it in 89. Fair market value is 40 lakhs. Krishna sold this land during the previous year for 2.75 crores, stamp value being 3 crores. Compute if Krishna has invested in 2 apartments costing 80 lakhs each costing rupees 80 lakhs. I'm working out this more because in examination it should click you. That's why I always feel that these type of questions are always favorite. Can you tell me for year of gift May 2012 1213? யாராவது ஒருத்தர் வச்சுக்க சொன்னாங்க
200, sir.
We'll take the break in some time.
So just a minute, sir.
Yeah.
Sir, I have a doubt.
Yeah, ask your doubt.
Sir, why is exemption under section 54F not applicable here?
Because what is sold is land. Sorry.
Land.
Yeah, it should be land and building. I only made the question. Okay, it should be land and building only. Please change it. Please change it because I know the intention is something else. Okay. Otherwise, it's only 54F. You are right. Okay. Otherwise, 54F only. Okay. Friends, I want you to just listen once more. Okay. I want you to just listen once more. The same question I am going to work out. Okay. The same question I am going to work out applying the provisions of Manjula Jesha, applying the judgment of சும்மா உங்களுக்கு I to just show you. Okay, in exam you need not work out. So what happens is this becomes 100. This becomes 100. Okay, okay, this becomes 100 base year. Okay, so what happens is, okay, this becomes 100. So now you see gross LTCG. Okay, since the gross LTCG is not exceeding 2 crores, exemption can be claimed, okay, for two house property, okay, two house properties. Okay, so exemption will become 1 crore 60 lakhs. Exemption will become 80 lakhs into 2. That's why all are saying this case law should be applied to. You can see how big the difference is, but in examination, don't apply this. And once one question I want to work out and show you how when two properties can be claimed.
Sir,
Raja, listening.
சார் இந்த ப்ரொவிஷனோட லாஜிக் என்ன சார்? அந்த 2 crores மேல போனா 2 ஹவுஸ் ப்ராப்பர்ட்டி எடுத்துக்கலாம், எடுத்துக்க கூடாது, கீழே இருந்தா அது
இல்ல ஒன்னும் லாஜிக் இல்ல ராஜா. ரெஸ்ட்ரிக்ட் பண்ணிருக்க வேணாம், ஒன்னும் லாஜிக் இல்ல அதுக்கு.
சார் ஆக்சுவலா வந்து எக்ஸீட் ஆனா தானே சார் 2 ப்ராப்பர்ட்டிஸ் கொடுக்கணும்.
ஆக்சுவலா எக்ஸீட் ஆனாதான் டு the எப்பவுமே this thinking of let the rich tax pay more tax. It's not, I don't find it. Yeah. This is not the time to discuss on opinions, so let's keep progressing. Divya Murli sold to Divya Palniappan urban agricultural land for rupees 80 lakhs in March 20. Stamp value on that date 1 crore. Divya Murli had purchased it for 32 lakhs. Compute if she invests 30 lakhs in another agricultural land, 54B. If she invests rupees 30 lakhs in residential property, she is already owning one house property. Okay, she is already owning one house property. 54F. She can own one property, still she can claim. Only if she is already owning two, she cannot claim. This is 54B. Case B is 54F. Is the transaction attracting any tax in the hands of Divya Palniappan? Because Is she having inadequate consideration? Buyer. Is she having inadequate consideration? 80 lakhs into 105%. 80 lakhs into 105%. How much it comes to? 84 lakhs. Correct?
Yes, sir.
Yes, sir.
But it is she has purchased it for I'm sorry, she has whereas the stamp value is 1 crore. So yes, it is having an impact in the hands of Divya Palniappan also. She need to pay tax, inadequate consideration tax on 20 lakhs. She need to pay inadequate consideration tax 20 lakhs. These two are for seller. 54B, 54F, you know the computation. This is for the buyer, section 56. Since the inadequate consideration exceeds 50,000, whole of the inadequate, and also 105% of stamp value of actual value. So whole of that is taxable. Whole of that is taxable. Naji converted his asset as stock in trade. How will capital gain be computed? What, okay, this is homework question. Question number 8, homework question. What would have been the computation if stock in trade is converted into capital asset? Quickly write down whatever I am saying. Conversion of asset into stock in trade. Conversion of asset into stock in trade. Under that, point wise. Conversion of asset into stock in trade, point wise. 1. FMV on the date of conversion is FVC, full value of consideration. FMV on the date of conversion is FVC, full value of consideration. 2. Taxable only in the year stock in trade is sold. Taxable only in the year stock in trade is sold. Next. Conversion of stock into capital asset. Conversion of stock into capital, heading conversion of stock into capital asset. Under that, FMV on the date of sale, on the date of conversion will be treated as sale consideration. FMV on the date of conversion will be treated as sale consideration and business profit will be computed. Business profit will be computed. We will take the break after the 10th question. I'll come back and do slump sales. Question number 10. Depreciable asset. Depreciable asset. Question number 10. Capital gains on depreciable asset. Under that, if the block ceases to exist, which we saw in the morning itself. If the block ceases to exist. If the block ceases to exist, will be treated as STCG or STCL. Will be treated as STCG or STCL. We start back. We start back, friends. Okay. And before progressing, to the next chapter, let me tell you a small thing about slump sales. Slump sales. Sale of unit of an undertaking without assigning values to individual assets or liabilities. You just sell the unit as it is. We will not assign the value for individually what is land, what is plant and machinery, what is debtors, what is creditors. We don't know. We sold the unit as it is. Sale of an unit of an undertaking without assigning values to individual assets and liabilities. Okay. FVC will be the wholesale value. Okay. Cost of acquisition, friends. Cost of acquisition will be the net worth of the unit transferred. Net worth of the unit transferred. Okay. No indexation benefit. If the unit transferred is existing for more than 3 years, then LTCA. Otherwise, STCA. Okay, so 36 months is the criteria. Okay, for LTCA or STCA. What is net worth? What is net worth? Assets minus liabilities. Okay, assets minus liabilities is equal to net worth. Assets minus liabilities is equal to net worth, my dear friends. Assets minus liabilities. For land, take the original cost. Ignore revaluation if any. So, revaluation should not be taken. You should take only the original cost. For depreciable asset, take the WDV as per IT law as on 1st April 2019. As on 1st April 2019. For depreciable asset, take the WDV as on 1st April 2019 as per IT law. Others, book value. Note, if depreciation needs to be provided but not provided, we should provide the same and arrive at the value. I will do question number 12. I will do question number 12, leaving 11 to you. Leaving 11 to you. Beta Limited has two units, one in hardware and the another is in software. As a restructuring drive, the company has decided to sell its software unit for a slump sales of 520 lakhs to a company called Theta Limited, in which it holds 82%. The balance sheet on the date, fixed asset, hardware, software, debtors, hardware, software, inventory, hardware, software, the current liabilities, hardware, software. The software unit is in existence since April 2015, more than 5 years. Fixed assets of software unit, which includes land 40 lakhs in the year 2018, revalued, but I will only take 40 lakhs. Depreciable fixed asset is 140. What is the total fixed asset of software? 200. Out of this 60, they have saying land, but we will take only 40. Okay, 140. As per IT law, it is only 90 lakhs. We want only, not as per books, as per IT law. Ascertain the capital gain, assuming 65 lakhs is invested in NHAI. First, we will compute. Okay, step 1, computation of net worth of software unit. Computation of net worth of software unit. Land. Okay, only book value to be taken. Ignore revaluation. So I will take only 40 lakhs. Depreciable assets. WDV as per IT law. WDV as per IT law, 90 lakhs. 90 lakhs is the WDV as per IT law. Debtors, 1 crore 10 lakhs. Others are book value as it is. Inventory is 35 lakhs. Less current liabilities 90 lakhs. Okay, net worth of the unit is 1 crore 85 lakhs. One crore 85 lakhs. Computation of taxable capital gains. Full value of consideration 520 lakhs. 520 lakhs. Full value of consideration 520 lakhs. Less cost of acquisition, nothing but the net worth is 185 lakhs. Gross LTCG as the unit is in existence for more than 36 months. If at all slum sales question come, don't miss it. It is very straightforward computation.
So for other assets, if they give revaluation, we can consider it.
Debtors revaluation irukadu. Assets, fixed assets revaluation.
Okay.
But
Okay, sir.
whatever they give revaluation, don't consider. Couple of minutes. You go through this. I will just prepare the Excel sheets ready. Couple of minutes. Please go through this patiently. Yes, sorry. I should have given you that. Exemption under section 54 EC. Amount deposited, I think, comes to 60 lakhs or so. 65 lakhs. Okay. Gross LTCG is coming to maximum limit, whichever is less, so 50 lakh. Please read the theory. Take few minutes, read the theory. There is two amendments. One is standard deduction becomes 50,000 and this extra contribution, okay, pension fund, okay, 14% of salary for government. This is also an amendment.
So can you please show me the 54 EC exemption in the last sum, sir?
Yeah, sure.
Thank you, sir.
They will start as you go by, you will understand it. A simple, I mean, a very good chapter. We have done enough in the classrooms and you have a very good knowledge. As we goes by, we will understand every part of it. Question 1. Mr. A, an employee, instructs his employer that he is not interested in receiving the salary and the same might be donated to a charitable institution. Question 1. Even if salary is foregone, it is taxable in the hands of employee. Even if the salary is foregone, it is taxable in the hands of employee, my dear friends. It is taxable in the hands of employee. Hence, even if the salary is donated, the same will first be taxable and 80G can be claimed. The same will be first taxable and maximum is that you can claim 80G.
சார் பட் எம்ப்ளாயர் வந்து அதை என்ன வேணாலும் பண்ணலாமே சார், டொனேட்டா பண்ணணும்னு இல்லை, சஜஷன் தானே சார் கொடுக்குறாங்க.
Foregoing salary is you are taxable. I'm not even worried what the employer does. If the employer gives you a donation receipt, consider it. That's all.
Sir, an 80G can be claimed by the employer or employee?
Employee. He only has donated.
Okay.
It is his salary which got donated. Question number 2. This goes to the basic concept of salary is taxable either on due basis or on receipt basis, whichever is earlier. So what happens if A draws his salary in advance of April in the month of March 20 itself? Okay, salary of April received in advance in March itself, taxable in FY 1920, taxable in financial year 1920. B. If salary of March is due and received only in, salary of March is due, received in April, taxable in 1920, on due basis. Can I change the chat once? Question number 3. Mr. Rajkumar, we are going to talk about allowances now in question number 3. We are going to talk more about allowances. Mr. Rajkumar has the following receipts from his employer: basic pay, DA, commission, motor car for personal use, expenditure met by employer, house rent allowance 900. Find out the amount of HRA eligible for exemption to Mr. Rajkumar, assuming that he has paid a rent of 1000 per month for his accommodation in the non-metro place, Kanpur, in Kanpur. DA forms part of salary for retirement benefits. So, question 3, full of allowances. Now I am going to talk about part A, which is we are going to talk about HRA. Salary is equal to basic pay plus DA forming part plus commission as a fixed percentage of turnover. Okay, in this case, how much is the salary? Basic pay 3,000 into, sorry. Okay, in this case, basic pay is 3,000 into 12 plus DA forming part is 600 into 12. Is commission paid as a fixed percentage of turnover? No, it is just commission of 6,000 per annum. So I should not take commission. So 43,200 is the salary. Okay, from 43,200 is the salary. Computation of taxable HRA. Computation of taxable HRA. Actual HRA received. Okay. Actual HRA received. It is 900 per month. Okay. Is equal to 900 into 12. 10,800. Less exempt under section 10 subsection 13A. Okay, actual received okay, we all know it is 10,800. Okay, rent paid minus 10% of salary. Rent paid is 1,000 per month. Rent paid is, my dear friends, 1,000 per month minus 10% of salary. 10% of salary. Okay, 40% of salary. 40% of, because it is in Kanpur, 40% of salary. Whichever is less is going to be exempt. Whichever is less is going to be exempt. Taxable HRA. Taxable HRA is going to be, okay, 3120. Taxable HRA 3120. Case B. Shrikant has two sons. He is in receipt of children education allowance of 150 per month for his elder son, 70 per month for his younger son. Both his sons are going to school. He also received the following: transport allowance, HRA 5,000 per month, salary for the purpose of HRA 20,000 per month, and rent paid in Salem 7,500 per month. Compute his taxable allowances. Okay, part B. First, let me talk about children educational allowance. First, let us talk about children educational allowance. First son, okay, elder son, he is receiving 150 per month. He is receiving 150 per month. So 150 into 12 less exempt. Okay, less exempt is 100 into 12. So 600 taxable. Okay, second son, okay, received itself is 70 per month. 70 per month. Okay, less exempt is also only 70 per month. Okay, exempt is also only rupees 70 per month. So the taxable value will be 600. யாராவது நம்ம ஒரு எக்ஸாமினேஷன் டென்ஷன்ல if we add 1800 plus 840 2640 minus 2400 we would have got only 240. We would have gone wrong in our answer. We would have if one of the child is getting less than 100 rupees, because maximum 100 rupees means if it is less than 100 rupees, that amount will only get exempt, not 100. Now HRA, we all know salary is 20,000 into 12, that is 2,40,000. That is what the question says, 2,40,000. Okay, actual HRA received 5,000 per month. So 5,000 into 12, 60,000 less exempt under section 10 subsection 13A. Okay, actual received, we all know 60,000, rent paid minus 10% of salary. The question says he is residing in Salem, paying a rent of 7,500 per month. So 7,500 into 12 minus 2,40,000 is the salary into 10%. And since it is not a metro, 40% of salary, 2,40,000 into 40%. Okay, so whichever is less, is exempt. So minimum of these three things is exempt. So what happens to the taxable is nil. Taxable HRA is nil. Thank God you're all there. Okay, I am going under the belief that you are just recollecting these things. If you don't understand anything, stop me, nothing wrong. Traveling allowance, okay, traveling allowance is 1,800, transport allowance 1,800 per month. Okay, transport allowance fully taxable, okay, is, my dear friends, 1,800 into 12. Okay, total taxable allowance.
So just a general doubt, transport allowance is totally different from travel allowance, no sir?
Traveling allowance is given for official purpose. Transport allowance coming to home from office, office to home.
Okay, sir.
Okay, C is nothing but project allowance paid outside India is not taxable. C is nothing but Ayush, an employee of the management consult, was sent to UK in connection with the project of firm's client for 2 months. In addition to his family, the salary, the firm paid per day allowance for the period when he worked in US, UK. Tax was not deducted by the employer. Ayush did not include this allowance in computation of taxable income. Okay, அதோடு நிறுத்தலாம் உங்களுடைய இது part C. Okay, any project allowance paid outside India is not taxable.
சார் பட் அப்படி ஒண்ணுமே பார்க்கலையே சார். நம்ம சிட்டி காம்பன்சேஷன் தானே சார் டாக்ஸபிள் பார்த்தோம். இங்க சிட்டிக்கு காம்பன்சேஷன் டாக்ஸபிள்னா ஃபாரின் சிட்டில காம்பன்சேஷன்
இது fully exempt allowanceல என்னெல்லாம் எழுதி இருக்கும்?
இன்னொரு நோட் இருக்கு சார், திறக்கணும். நீங்களே சொல்லுங்க சார்.
அதாவது allowance, daily allowance paid to High Court, Supreme Court judges. Okay, allowance paid to ambassadors and high commissioners outside India. Project allowance paid outside India. Not taxable. Right? Anything paid outside India, although he is paying for boarding and lodging purposes, not taxable. Okay, so if you want to be very honest to you, I have taken all questions of CA final and answering. I have taken, okay, when I answered the CA final students, I told this, that, okay, if I give these questions to my inter student, within no time they will give the answers. Within no time. Okay, every question. அதனால தான் இந்த 143.3 இதெல்லாம் assessment procedure னு பேரு. Okay, so that is why it is coming like this. But otherwise, I'm just taking CA finals question and answering to you. When I answered itself, I was very confident. இதெல்லாம் நீங்க அப்படி தலைவர் ஸ்டைல டிங் டிங் தான் நமக்கு. Okay, question 4. Question 4 is full of perquisites. Question 4 is going to be full of perquisites, my dear friends. Question 4 is going to be full of perquisites. Okay. Mr. D went on a holiday on 25/12/2019 to Delhi with his wife and 3 children. One son aged 5 years, twin daughters aged 2 years. They went by flight economy cost and the total cost of reimbursement was 60,000, 45,000 for adults and 15,000. Okay, 45,000 for adults and 15,000 for 3 minor child. Compute the LTC exempt. Compute the LTC exempt. Okay. Part A. Normally, LTC is exempt by shortest route for assessee, spouse, and only 2 children. However, if the second is twins, then 3 children can claim the exemption. இதுதான் நம்ம provision of visa. Okay. In this case, the two, okay, first is a son and 10 daughters. Hence, assessee can claim entire rupees 60,000 as exemption.
So always the assumption is he has taken the shortest route.
Right. Yes, always the assumption is. Compute the taxable value of perquisite of medical facility. Can I quickly recollect? Government hospital nil, employer owned hospital nil, sorry, treatment for specified disease nil, Treatment outside India due to lack of medical facility in India, nil. For assessee, spouse, children and dependent parents only this. Any other thing will be taxable. Medical and medical insurance premium paid is also treated as medical purpose. Medical insurance premium paid for ensuring the health of the employee, taxable. Treatment by family doctor, taxable.
But
Treatment of
first one,
Mrs. G.
so first one medical insurance premium paid for ensuring the health வந்து கிளியரா ஐசிஐ புக்ல எக்ஸம்டன் கொடுத்திருக்காங்க சார். இதே இல்லுஸ்ட்ரேஷன் இதே கொஸ்டின் அதுக்கு எக்ஸ்பிளனேஷன் வேற கொடுத்திருக்காங்களே.
அவங்க எக்ஸம்டன் ஏன் கொடுக்க இதுக்கு என்ன எக்ஸ்பிளனேஷன் கொடுத்திருக்காங்கன்னு நானும் படிக்கிறேன். காத்தால நீ கொண்டதுக்கு காத்தால நீ கேட்ட இல்ல அது வந்து ஒன்லி ஃபார் இன்கம் 80I ராஜா. சோ யூ ப்ளீஸ் கிளைம் 80AEA 80EB. அவங்க ஏன் எக்ஸம்டன் கொடுக்கறாங்கன்னு நான் சொல்றேன். Because this 7,000 can be added and claimed under 80D. இல்ல ரெண்டுத்தையும் நீங்க மிஸ் பண்ணலாம். You can add it, you can take this as a perquisite. அப்பனா என்ன ஆகும்னா it is as if paid by Mr. G. Okay, and you can claim it as a deduction under இது. Group insurance premium தான் exempt. அவங்க என்ன சொல்றாங்க மெடிக்கல் இன்சூரன்ஸ்னாலே இது group insurance அதனால exemptன்றாங்க. My opinion is please tax it. Please tax it. Okay, if the same question appears you can write the two notes which I tell you, that is group insurance not taxable. However, this can be claimed under 80D. So
sir, how can we claim it under 80D, sir? It is not paid by Mr. G, right?
Once you tax it, it is as if you have paid it.
Okay.
Okay. Ignore பண்ணலாம். Ignore the income also, ignore 80D also. Coming back, treatment of by family doctor taxable. Mrs. G in a government hospital exempt. Mr. G's grandfather taxable. G's mother dependent family doctor taxable. Treatment of G's sister in a nursing home taxable. G's brother taxable. G's father abroad. Okay, what happens is 50 plus stay period 30, but RBI only allowed 75. So the remaining 5,000 will become taxable. The remaining 5,000 will become taxable.
So J's brother is independent, no sir?
Medical purpose is fully taxable.
So then okay sir.
One minute. Keep working. Trying to save some time. ஏற்கனவே நான் வந்து ஃபைனலுக்கு இது போட்டேன், அதனால I'm trying to pick that. Since I have told you how to answer, I thought I can take this short route. Here is what our friend says. Okay.
Sir,
சொல்லுங்க.
but both in your notes and book you have given dependent brother, sister, and parents, sir. Children, it is whether dependent or not, but
எதுக்கு இது சொல்றீங்க நீங்க?
so that brother they have given in bracket independent, sir.
So what? அதான் சொல்றேன். இப்போ கவர்மெண்ட் ஹாஸ்பிட்டல், எம்ப்ளாயர் ஓன்ட் ஹாஸ்பிட்டல், ட்ரீட்மெண்ட் அவுட் சைட், அப்பதானே உங்களுக்கு அந்த டவுட்டே வரணும். எல்லாமே டாக்ஸபிள் தானே.
Okay, sir.
Okay, right. Okay, I'm progressing.
Sir.
I'm progressing.
Sir, just a minute, sir.
You want the answer, huh?
Yes, sir.
Mr. C is a finance manager of ABC Limited. The company has provided him with rent-free, unfurnished accommodation. He gives you the following particulars. Basic salary 6,000 per month. BNS allowance 2,000, 30% forms part. Bonus 1,500 per month. Even though the company allotted him from 1/4, he occupied only from 1/11. Only from the date of occupation. Note 1. Only from the date of occupation, RFA needs to be computed because that is the date from which he gets the benefit. That is the date from which he gets the benefit. So, only from the date of occupation, RFA needs to be computed. Only from the date of occupation, RFA needs to be computed. Okay, compute the taxable value of perquisite. My dear friends, RFA, if you look at that theory, 15% of salary. And when you say what is salary, basic pay plus DA forming part plus all monetary receipts plus all other allowances to the extent they are taxable. To the extent they are taxable. So this 6,000 I will include in this 2,000, 30%. That is 600 I will include 6,600 plus 1,500. Okay, 6,000 plus 600 plus 1,500, 8,100 into 12. 8,100 into 12. Okay, so compute taxable value of perquisite is 15%, sorry, 8,100 into 5, sorry. 8,100 into 5, only from November. Only from November, I'm sorry. 8,100 into 5. Okay. 15% inga taxable. Okay, shall I go to better? Part C. Okay, salary for RFA. Okay, basic pay. I will take the 6,000. Okay, DA forming part. I will take 2,000 into 30%. Bonus, I will take 1,500. Okay, total per month is okay is 8,100 for 5 months only. For 5 months only, that is November to March. Okay, from the month of occupation of property. Okay, from the month of occupation of property. So 8,100 into 5. Okay, 40,500. Okay, case A. Case A. Okay, 15% of salary is the perquisite value into 15%, 6075. Case A, 6075. Case B. What does it say? Compute the perquisite value if Mr. C is required to pay 1,000 per month as rent to the company for using, okay, concessional accommodation. So what happens? 15% of salary, which is nothing but 4,500 into 15%, okay, less rent recovered 1,000 per month. So for 5 months, 5,000. So 1,075. Case C. Compute the value of perquisite if ABC has taken this accommodation on a lease rent of 1,200 per month and C is required to pay 1,000 per month as okay. Case C. Employer takes it on lease. So what happens? 15% of salary, 15% of salary, which is 6075, actual rent paid by employer, actual rent paid by employer, 1,200 into 5. Whichever is less becomes PV. So whichever is less becomes the perquisite value, less amount recovered from employee is 1,000 per month. So my perquisite value becomes 1,000. Case D. Compute the value of perquisite if ABC Limited has provided furniture, television, cost தான் நம்ம எடுக்கணும். Okay, 25,000 and 2 air conditioners. The rent paid by the company for the air conditioner is 400 per month each. TV was provided on 1/1/2020. However, C is required to pay a rent of 1,000 to the company for use of this furnished accommodation. Case D, furnished accommodation. Okay, 15% of salary, we all know 6075. Okay, 10% of cost of TV for 3 months. For 3 months, because only from 1st Jan it is being used. Only from 1st Jan it is being used. Television cost is 25,000. Television cost is 25,000 into 10% into 3 by 12 into 3 by 12. Okay, higher charges for AC. Okay, it is 400 into 2 ACs into 5 months. 400 per AC. So 2 ACs are taken on hire. So for 5 months, again from November to okay, 400 into 2 ACs into 5 months. That is nothing but November to March. That is the period he is occupying. Less amount recovered, okay, is 1,000 per month. Okay, so the perquisite value will be compute the perquisite value. If Mr. C is a government employee, the license fees determined for this accommodation was 700 per month. Okay, case E for government employee. Okay, license fees into number of months. So because it is given monthly, otherwise I would have done it as square feet basis. கலந்து ராம்ஜி திட்டுவான் அவங்கன்னு சொல்லியிருக்கேன்.
சார் நான் எதுவுமே சொல்லலையே சார்.
நீ சொன்னியடா அந்த டிஸ்டர்பிங் கேர்ள் ரொம்ப படுத்தும்.
So what is license fees, sir?
License fees is area-wise government will determine what is the stamp value மாதிரி guideline value. So accordingly it's known as license fees.
Okay, sir.
Sir, if nothing is provided, should we assume that it's owned by the employer, sir?
Yes,
The house?
yes. Otherwise they will say what is the employer rent paid.
Okay, sir.
Part D. Find out the taxable value of the perquisite from the following in case of employee. Okay. Purchased in May 2017, transferred to employee in June 2019. So for 2 years, I should provide the depreciation. I should provide the depreciation. Car rate of depreciation 20% for every completed year from the date of its purchase. 2 years has been completed. Laptop 50% from the date of its purchase, 2 years. Furniture 10% SLM. Furniture alone 10% SLM. If I can take a small root, okay, because you can understand, I am taking this root.
Sir, can you please scroll down up, sir?
For this one now. This is original cost, depreciation at 20% for year 1. On the WDV, depreciation for year 2. This is the May 19 value less amount recovered. This is for computer. May 17 value less depreciation at 50%. May 18 value again depreciation. May 19 value only if the year is completed I will provide, then I get 5625. Furniture SLM basis for 2 years.
Sir, computers curtain, sir.
X Limited provides the following particulars of perquisites for an employee. Okay, friends, just keep trying. Just give me 5 minutes, I'll be back. Just keep trying. E alone, please keep trying. I'll be back. I'll be back. Yeah, friends. I hope E is done. I'll show you the answers. This is part E. Concessional length. Lease rent paid by the company is 15,000 into 12. We have to assume that as minimal because they have not given what is the other thing. Okay, 15% of salary they have not given. So we have taken it as minimal. I have taken it as minimal and worked out. Furniture hire charges. Yes, friend.
Salary for the purpose of RFE at 10 lakh.
They have given salary, sir.
Oh, okay.
Yes, sir.
Then I'm wrong. I don't know how I missed it in final. Okay. 15% of salary, okay, should be 10 lakhs into 15%. So that being the minimal, I should have taken this as 150 minus 60. Now I am entering the terminal benefits. Okay, question 5 is full of terminal benefit. We are going to answer question 5 full of terminal benefits, my dear friends. Question 5 is full of terminal benefits. Mr. Sagar retired on 1/10/2019, receiving 5,000 as pension. On 1/2/2020, Feb 2020, he commuted 60% of his pension and received 3 lakh as commuted pension. You are required to compute the taxable pension, assuming he is a government employee. He is a private sector employee receiving gratuity 5 lakh. He is a private sector employee not receiving gratuity. So, in this part A, we are going to see about pension. In this part A, we are going to see more about the pension. Okay, so let me talk about the uncommuted pension last. First, I am going to do commuted pension. Okay, commuted pension fully exempt for government employees. Commuted pensions are fully exempt for government employees. Then particulars in receipt of gratuity, not in receipt of gratuity. Okay. So then the other private sector, as far as private sector is concerned, in receipt of gratuity, not in receipt of gratuity. Commuted pension received. Okay. Commuted pension received 3 lakhs. Okay. 3 lakhs. Less exempt. Okay. 1/3 of the eligible pension, 1/3 of the eligible pension, that is, okay, that is, my dear friends, 3 lakhs divided by 60 into 100 into 1 by 3 if the employee is in receipt of gratuity. 1/3 of the eligible pension, nothing but 3 lakhs divided by 60% into 1 by 3. Okay, 1/3 of the eligible pension if the employee is receipt of gratuity. Half of the eligible pension, okay, if the employee is not in receipt of gratuity, okay, 60% into 1 by 2. Okay, so here this will be, okay, 3 lakh divided by 60% into 1 by 2. Okay, so taxable commuted pension, taxable commuted pension is uncommuted pension. Okay, let us understand this. He retires on 1/10/2019, 5,000 per month. So, October, November, December, January. Repeating, October, November, December, January. All the 4 months, he will get 5,000 per month. All the 4 months, he will receive 5,000 per month. Okay, from October to Jan. Okay, for okay 5,000 into 4, so it will be 5,000 into 4. On 1st Feb he commutes 60%, therefore uncommuted is 40%, that is 5,000 into 40%, which will be 2,000 rupees. 5,000 into 40% will be 2,000. For Feb and March, okay, 2,000 per month. Okay, so 2,000 into 2, okay, total uncommuted pension taxable for all assessees, be it government employees or anything, it is taxable for all assessees, okay, is 24,000. Is 24,000. Is 24,000. 24,000. Okay, you are right. Okay, 24,000. The B, second, Mr. Ravi retired on 15/6/2019 after completing 26 years and 8 months of service and received a gratuity of 6 lakhs. At the time of his retirement, basic salary 5,000, DA 3,000, 60% forms part, and commission 1% of turnover of 12 lakhs, bonus 12,000. Compute his taxable gratuity assuming covered under POGA, not covered under POGA, and he is a government employee. Okay, okay. only the second condition and the explanation to salary. So let's go slow. Let's go slow so that we are understanding every part. Okay, part B. This is fully of gratuity. Okay.
Sir,
Raja.
sir, uncommuted pension on the government employees for taxable, sir.
Uncommuted for all taxable.
Okay.
Covered under POGA. First I am working for covered under POGA. Salary is equal to basic pay plus full DA. Salary is equal to basic pay plus full DA. So it will be 5,000 plus 3,000, 8,000. Salary is equal to basic pay plus full DA. Gratuity received. Gratuity received is 6 lakhs. Gratuity received 6 lakhs. Less exempt under section 10 subsection 10. Actual received 60 lakhs. 15 by 26 into 8,000, okay, into 26 years and 8 months, 27. If it is more than 6 months, round off at the upper end. If it is up to 6 months, round off at the lower end. Okay, okay, 15 by 26 into 8,000 into 27. Okay, 15 by 20. Oh, sorry, 6 lakhs, 60 lakhs put that. Okay, maximum limit 20 lakhs. Okay, minimum of these three things is exempt, taking you to a taxable gratuity of 4,75,385. Not covered under POGA. Not covered under POGA. Okay, I am going to work out average salary. I am going to work out average salary. Average salary means 10 months average to be considered. 10 months average to be considered. Okay, basic pay. Let us take 5,000 into 10, 50,000. Basic pay 5,000 into 10, 50,000. DA forming part should only be taken. Okay, 3,000 into 60%, 3,000 into 60% into 10 months. 3,000 into 60%, 1,800 into 10%. Commission as a fixed percentage of turnover. Commission as a fixed percentage of turnover. Okay, the question says turnover as 12 lakhs into 1% into 10 by 12 into 10 by 12 for 10 months we need it. Okay, so salary for 10 months. Salary for 10 months will be this amount. average salary, okay, average salary will be this divided by 10. Average salary will be 7,800.
So this average will have a significance only if in the middle of the year there is a change in the salary or something. Or else if we take for 1 month, what's the same answer?
Yes, 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 you are right. Very good. You are right. You are right.
Okay. Sir, and if no information is given, we have to assume it's not covered under
Yes, if no information is given, not covered. So this will be, the second condition will be 15 by 30 into 7,800 into only 26. Completed years of services only. 15 by 30 into 7,800 into only 26 completed years of service.
So this gratuity exemption, sir, under section 1010. So this, suppose we commute around 40% now, and after 2 years we compute 20%. Still, this exemption is available, or how is it, sir?
Available.
Okay.
Available.
Okay.
But gratuity cannot be commuted like that. You are talking about commuted pension. Yes, available.
Commuted pension. Sorry, sir.
Pandray Vijay, sure. Okay, right. Government employee. In case of government employee, whole of gratuity is exempt. In case of government employees, whole of gratuity is exempt. Question C. Mr. Gupta retired on 1/12 after 20 years and 10 months, receiving leave encashment of 5 lakh. Other details: basic salary, dearness allowance, commission, bonus. Leave availed during the service 480 days, entitled for 30 days of leave every year. You are required to compute if he is a government employee, non-government employee. Leave encashment, the working is, exemption is actual received 10 into average salary, recompute on the basis of 30 days of leave. So here the company policy and our policy is the same. 30 days of leave for every completed year of service or part thereof. Either you can do it in days, or if it exactly comes in months, you do it in months, or the maximum of 3 lakhs, whichever is less. And salary, average salary has the same meaning, So we will start working. Part C, leave encashment. Part C, leave encashment. Computation of salary. Computation of average salary. Basic pay. The question says he is 5,000, which is increased by 1,000 per month. So okay, April, May, June, July, August, September, October, November. He is retiring on 1st December. So 8 months it was 5,000. First 2 months it was 4,000. Repeating, he is retiring on 1st December. I need the salary till 30th November. So 10 months means February to November. February 2019 to November 2019. Feb and March it would have been 4,000 per month. From April till November it is 5,000 per month. So basic salary will be 4,000 into 2 plus 5,000 into 8. Basic salary will be first 2 months, Feb and March, 4,000 because I need for 10 months, and April to November. Okay, April to November. These 8 months, 5,000 per month. DA, okay, it's fixed sum only. 3,000 per month, 60% forms part. So 3,000 into 60% into 10 months. 3,000 into 60% into 10 months. Okay, commission is not fixed percentage of turnover. Bonus I will not take. So total salary becomes 66,000. Total salary becomes 66,000. Average salary, okay, average salary is divided by 10, 6,600. Average salary is divided by 10, 6,600. Leave entitlement, number of years of completed service into 30 days per year. So leave entitlement 20 into 30, 600. Okay, 20 into 30, 600. Less availed is 480 days. So unavailed period, okay, 120 days. Unavailed period, 120 days. Unavailed period 120 days. So now I am computing the exemption. Computation of taxable leave salary. Okay, actual received. Okay, actual received 5 lakhs less exempt. Okay, actual is 5 lakhs. 10 into average salary. Okay, 10 into 6,600. 10 into 6,600. Okay, unavailed period, that is 4 months. Since it is coming exactly as 120 days, I can take 4 months into average salary. Okay, so 4 into average salary of 6,600 and maximum limit is 3 lakhs. Okay, whichever is minimum is exempt. Taxable leave encashment is 4,73,600.
Sir, can you explain the basic pay again?
Basic pay I need for 10 months. He is retiring on 1/12/2019. So I need for November, October, September, August, July, June, May, April, March, Feb. These 10 months. So with effect from April, I had received 1,000 as increment. So April to November, it should have been 5,000 per month. Feb and March should have been only 4,000 per month. Feb and March should be 4,000. So 4,000 into 2 plus 5,000 into 8.
Sir, this 5,000 is the latest payment. That
At
is
the
last
time
draw.
of retirement.
Oh, okay, sir.
So in case we don't get the whole month, sir, we'll do it as 120
Leave
divided.
that month and take the preceding months.
Sir, can you repeat it?
Suppose you are retiring on December 15th. Leave December and take from November 10th.
No, sir. For the unavailed period, we will have 120 days divided by 10 months only. No, sir. We have to take the days.
No. For this means you are talking about this condition.
Yes, sir.
Whatever is the number of days divided by 30 into average salary.
Okay, sir.
Okay, now we will understand something more. Question number 6. Mr. A retires from service on 31st December 2019. 31st December 2019 after completing 25 years of service. Following are the particulars of his income or investment. Basic pay, dearness allowance, 50% forms part of retirement benefit, 8,000 per month for 9 months. Lump sum received from URPF, deposit in PPF 80C, deposit in PPF 80C. Out of the amount received from URPF, the employer's contribution is 2,20,000 and interest thereon 50,000. Employer's contribution and interest on employer's contribution is taxable as salary. Repeating, employer's contribution and the interest on employer's contribution is taxable on salary as salary. Employees contribution not taxable because in the respective years you would have taxed it. Employees contribution not taxable. Interest on employees contribution. Interest on employees contribution is taxable as IFOS. Interest on employees contribution is taxable on IFOS. What is the taxable portion of amount received from URPF in the hands of Mr. A? Okay, repeating, probably I have given the theory for that also. I remember typing it for everything. URPF, okay, fully taxable except for employees' contribution. So, but with a small difference, employer's contribution and interest on employer's contribution as salary, interest on employees' contribution as this one, IFRS. Mark it as homework. Mark it as homework, please. Mark it as homework. Mr. Yes, friend.
Employer's contribution fully taxable or is exempt to 12%.
இது URPF. அதனால fully taxable at the time when the lump sum is received.
Okay.
RPF தான் up to 12% exempt, more than 12% taxable in the respective years, and lump sum is fully exempt. Mr. B is working in XYZ Limited and gives the details. You are required to compute his gross salary, basic salary, DA, commission, turnover, bonus, gratuity, his own contribution to RPF, which is allowed under 80C, which is allowed as a 80C. Employer's contribution to RPF, which is allowed to the extent of 12%. Okay, interest accrued on RPF at which is only allowed to the extent of 9.5%. Okay. Gratuity okay, they have given, so I am taxing it. Actually, during the course of employment, they will not give gratuity. Only it is a retirement benefit. But question is so we have taken it. basic pay plus DALO, how much? 50% forms part plus commission. Okay, this is okay. Actual contribution 20%. Actually, the employer has contributed 20%, less 12%. Okay, so what is allowed is 12%. So excess contribution comes to 13840.
Sir, what about employees' contribution, sir?
It is always part of this. That is, even though basic salary is 120, they will not give you 120. They will deduct 20%, okay, 20,000 and give you only 1 lakh and give you only 1 lakh. So it is always part of it. You will tax it on gross basis.
So what we are taxing here on gross basis only, we are going to subtract under 80C, sir.
Yes. Excess interest credited. Interest at 13% is 13,000. Yes. 9.5%. If this is 13%, what is 9.5%? Okay, the excess becomes taxable.
Sir, the employer's contribution is 20% of basic salary. That is what is given, sir. So even though it's given basic salary, நம்ம
No,
compute பண்ற
I'm
மாதிரி.
sorry. I'm wrong. I did not read it properly. Mr. Datta received VRS compensation of 7 lakh after 30 years and 4 months of service. He still has 6 years of service left. At the time of voluntary retirement, He was drawing a basic salary of 24,000, DA 5,000. Compute is VRS compensation, the taxable, that assuming that he has not claimed any other benefit. Okay, I would definitely request you to once look into the theory of VRS compensation. Okay, exemption is minimum of the following: actual received, salary per month into 3 months, that is what, into 3, into number of years of completed service. Otherwise, salary per month into number of months of services which is pending. Okay, repeating, salary per month into 3 into number of years of completed service, or salary per month into remaining months of service, which is maximum restricted to 5 lakhs. Sorry, I just copied it from here, I believe. Okay, it is 5 lakhs. It is not 3 lakhs. Okay, it is 5 lakhs, friends. This is 5 lakhs. Page number 45, take the correction. It is 5 lakhs. Computation of taxable VRS compensation. Okay, VRS compensation received, VRS compensation received 7 lakhs less exempt. You don't remember, if you don't remember the section, don't worry. Okay, not that I remember, that because of practice. Okay, don't worry. Section 10 எழுதினாலே over. Exempt under section 10. Wrong எழுத வேண்டாம். Section
Sir,
10.
அதான் சார் கேட்க வந்தேன். That's what I am coming to ask.
Yeah, I know, Ramji. Mind கேட்டுது, ஈரோடு தானே. Okay, so if you don't remember the section number, no, exemption under section 10, they will give you mark. They are not going to test the memory power. Okay, they will give you mark. Okay, right. Actual received 7 lakhs. Then salary. What is salary? 20 plus 5, 25,000 into 3 into number of years of completed service, 30. That is salary into, 3 months salary into number of years of completed service. So it will be 25,000 into 3 into 30 years of completed service. Okay, then next is he is having 6 years of service left, which means 72 months. Okay, he is having 6 years of service left, which means he is having 72 months of service. Okay, 72 months. So 25,000 into 72 months. Okay, 25,000 into 72 months. Maximum amount 5 lakhs. Question number 7. Question number 7. Examine the correctness or otherwise of the following cases in the context of provisions of IT law. Nargis, working as a regional area sales manager for a marketing company, was paid salary and commission based upon the turnover affected by her. Nargis claimed the expenses incurred by her for earning the commission in the return, which were disallowed by. Okay, in other words, you cannot claim commission as a fixed percentage of turnover is fully taxable. Salary has only 3 deductions: standard deduction, professional tax, and for government employees, entertainment allowance. So, Nargis cannot claim it. Okay. An amount of 12,50,000 paid by a company after approval of a board to a hospital in UK for the heart surgery of its managing director was charged under medical expenses. AO, while contemplate tax the amount so as a perquisite in the hands of managing director. Okay, medical perquisite is exempt in the following cases: treatment in government hospital, treatment in a hospital owned by employer, treatment for specified disease, treatment outside India due to lack of medical facility in India subject to RBI approval limit. Okay. In the given case, it is if the assessee is able to prove that medical facility is not in India, then not taxable. Otherwise, the AO is correct in taxing the income in the hands of the entity.
Sir, only for the traveling expenses, we will consider that gross annual income should not exceed.
Yes. Not for treatment.
Okay. Sir, and if it is like MD and all, we can't give traveling expense because obviously their income will be.
Very true. And even this will be taxable. In heart surgery and all, people from outside India come here and do.
So just a minute, sir. Can you please show that, sir?
Mr. X is a member of Legislative Assembly, underwent an heart surgery abroad, in respect of which he received 5 lakhs from state government towards reimbursement. AO contended that such amount is taxable as perquisite. Okay. One minute, I'll check the printer. Sorry. Part C. Part C. Okay, right? MPs and MLAs are not employees of the government, hence, the honorarium paid is not taxable under salary but under IFOS. So, any perquisite provided shall also be taxable only under IFOS. Mr. Kadam is entitled to a salary of 40,000. He is given an option by his employer either to take HRA or RFA, which is owned by the company. The HRA amount payable was 7,000 per month. The rent for the hired accommodation was 6,000 per month at New Delhi. Advise Mr. Kadam whether it would be beneficial for him to avail HRA or RFA. Give your advice on the basis of net take home cash benefit. Read through. Of course, this is, I cannot say that these questions are for you, but சும்மா work out பண்றேன். Just HRA RFA we can understand. Okay, that's why. Okay, salary. So it is
Sir,
just
for just a second, can you show me the part C, sir? Thank you, sir.
salary 40,000 each. HRA, what happens is he will receive 7,000 per month. 7,000 into 12, 84,000 less exempt, actual received, okay, 84,000, rent paid minus 10% of salary. Rent paid, he is going to pay 6,000. 6,000 is the rent paid minus 10% of salary. Okay, right? 50% of salary, which is 2,40,000. So whichever is less is exempt. So you will see that 24,000 is exempt. 24,000 is exempt. Okay. Whereas in the other case, if RFA, what happens is 15% of salary. If RFA, it is 15% of salary. Okay. So what happens? Gross salary will be, understand my dear friends, 480 plus, okay, 480 plus 84 minus 24. 4,80,000 basic pay plus 84,000 minus 24,000 minus 24,000. Okay, yeah, I understand. Yeah, 945 I will get over. Okay, gross salary 540 in the first case, whereas in the second case it will be, okay, 552. Whereas in the second case it will be 552. Standard deduction, here it will be 50,000. In both the cases 50,000. Taxable salary, okay, the unfortunate factors, tax, okay, tax, here it will be nil because your rebate covers. Here it will be, okay, for example, I'm giving you only the tax amount minus 5 lakhs into 20% plus 12,500. Okay, here there will be tax. Here there will be tax. Okay, here there will be tax. I'm telling you. Okay, and HEC at 4%. Okay, understand this, into 4%. Okay, so if you look at it here, if I mean, I need not even compute HEC and all. Here he will have a bigger benefit. Entire 590, 490 is enjoying, whereas here his salary is only 480. This is not a cash salary, but out of 480 he will also lose some 12,000 and odd. So it is not at all advisable to take RFA, take only HRA. Of course, not there in your syllabus, this one, not there in your syllabus, this one, do not worry.
Sir, the reason we are not going with RFA is we are paying extra tax, right, sir?
Yes.
For the same salary.
The net salary, then for the same salary, my cash component is also less. I am also paying tax.
Yes, sir.
I'll give you some guidelines. Tomorrow morning, if you want, I'll work. Mr. M is also working with MNO for last 10 years. He is granted an employee stock option. Remember, date of exercising the option by the company to purchase 800 shares at rupees 250 per share. The period for which the option can be exercised is predetermined commencing from 1/7 to 31/3. Mr. M exercised the option on 15/3 to purchase 500 shares. FMV on that date was 6,490 in BSE and 6,500 in NSE. Okay, the NSE recorded the highest volume trading, so we will take NSE. We should take NSE because that is where the entire thing is. The company has allotted 500 shares on 24th April 2019. The fair market value on the date of allotment is not needed. The option was granted for making available rights in the nature of determine the taxable value, nothing but 6,500 minus 250 into 800 shares. The question seems to be bigger. We all know excising the option.
So it will be into 500 or 800, sir?
How many shares he is taking up?
8, but they are allotting him
500, only 500. Only 500.
Okay.
Ajay is employed as a senior executive in Manu Limited. Manu Limited offers rights to its existing shareholder 1:1 at rupees 150. Ajay was offered 500 shares, 150. You are consulted the tax consequence, assuming that the fair market value on the date of excising option is 300. If Ajay is already a shareholder of 250 shares allotted in public issue, will it make any difference? Yes. If he is purely given as an employee, write down the answer. If Ajay is an employee, then it is taxable under salary. $150 into 150, or how many? 500 into 150. 500 into 150. If Ajay is an existing shareholder, and gets the share only due to his holding, then not taxable. We wind up here to meet you again at 6 a.m. tomorrow morning. All the homework questions, I will do it only tomorrow and post it. As of now, I will post the Excel directly. But with regard to homework question, I will tomorrow afternoon, I will work out both with regard to capital gains and salaries and post it. Yeah, somebody was asking me a question.
Sir, one small request from my side, sir.
Yeah.
Sir, can it be 6:30, sir? You can extend time up to 12 or 12:30, sir. It is fine, sir.
Yeah, okay.
Half an hour, sir.
Yeah, fine. 6:30, friends. Yeah, taken. 6:30, we will start. What time we end, we will decide tomorrow morning.
It's not a problem, sir.
Yeah, 6:30 we can start, friends. I don't have a problem. We will start at 6:30. I understand your case. Meet you tomorrow morning at 6:30. All the very best.